Techniques of costing, marginal versus absorption. Marginal cost is the amount at any given volume of output by which aggregate costs are charged if the volume of output is increased or decreased by 1 unit. Marginal cost is nothing but a cost which incorporates the incremental changes in the cost of production due to either an increase or decrease in the level of production by 1 unit, meant as incremental cost. Absorption costing means that all of the manufacturing costs are absorbed by the units produced. In other words, the cost of a finished unit in inventory will include direct materials, direct labor, and both variable and fixed manufacturing overheads. As a result, absorption costing is also referred to as full costing or the full absorption method. This lesson discusses both of them and issues related to them. It follows from the previous slide that after studying this lesson, you should be able to understand the meaning of marginal costing, distinguish between marginal costing and absorption costing, calculate income under marginal costing and absorption costing. The costs are classified into two categories, that is, fixed and variable cost. Variable cost per unit is considered as marginal cost of the product. Fixed costs are charged against contribution of the transaction. Selling price of the product equals to marginal cost plus contribution. Marginal costing profitability statement is shown on the screen. The cost volume profit CVP analysis helps management in finding out the relationship of costs and revenues to profit. The aim of an undertaking is to earn profit. Profit depends upon a large number of factors, the most important of which are the costs of the manufacturer and the volume of sales affected. Analysis of cost volume profit involves consideration of the interplay of the following factors: volume of sales, selling price, product mix of sales, variable cost per unit, total fixed costs. The objectives of cost volume profit analysis are: in order to forecast profit accurately, it is essential to know the relationship between profits and costs on one hand and volume on the other. Cost volume profit analysis is useful in setting up flexible budgets which indicate costs at various levels of activity. Cost volume profit analysis is of assistance in performance evaluation for the purpose of control. For reviewing profits achieved and costs incurred, the effects on cost of changes in volume are required to be evaluated. The ratio or percentage of contribution margin to sales is known as P/V ratio. This ratio is known as marginal income ratio, contribution to sales ratio, or variable profit ratio. P/V ratio, usually expressed as a percentage, is the rate at which profits increase with the increase in volume. Break-even analysis examines the relationship between the total revenue, total costs, and total profits of the firm at various levels of output. It is used to determine the sales volume required for the firm to break even and the total profits and losses at other sales level. In case of break-even analysis, the break-even point is of particular importance. Break-even point is that volume of sales where the firm breaks even, that is, the total costs equals total revenue. It is therefore a point where losses cease to occur while profits have not yet begun. That is, it is the point of zero profit. The break-even analysis can be performed by break-even charts and algebraic method. A break-even chart plots the sales revenue, different costs, and helps identify the break-even point and margin of safety. A business can work out what volume of sales it needs to achieve to cover its costs. This is known as the break-even point. The key to break-even is to work out the contribution made from the sale of each unit, the amount of money each unit sold contributes to pay for the fixed and indirect costs of the business. Break-even analysis can also be performed algebraically by applying the formula total revenue is equal to the selling price per unit times the quantity of output or sales. Break-even analysis is a very generalized approach for dealing with a wide variety of questions associated with profit planning and forecasting. Some of the important practical applications of break-even analysis are: what happens to overall profitability when a new product is introduced? What level of sales is needed to cover all costs and earn, say, rupees 1 lakh profit or a 12% rate of return? What happens to revenues and costs if the price of one of company's product is hanged? What happens to overall profitability if a company purchases new capital equipment or incurs higher or lower fixed or variable costs? Absorption costing is often contrasted with variable costing or direct costing. Under variable or direct costing, the fixed manufacturing overhead costs are not allocated or assigned to the products manufactured. Variable costing is often useful for management's decision-making. However, absorption costing is required for external financial reporting and for income tax reporting. In absorption costing, items of stocks are costed to include a fair share of fixed production overhead, whereas in marginal costing, stocks are valued at variable production cost only. The value of closing stocks will be higher in absorption costing than in marginal costing. As a consequence of carrying forward an element of fixed production overheads in closing stock values, the cost of sales used to determine profit in absorption costing will include some fixed production overhead costs incurred in a previous period but carried forward into opening stock values of the current period. Exclude some fixed production overhead costs incurred in the current period by including them in closing stock values. In contrast, marginal costing charges the actual fixed costs of a period in full into the profit and loss account of the period. Marginal costing is therefore sometimes known as period costing. In absorption costing, actual fully absorbed unit costs are reduced by producing in greater quantities, whereas in marginal costing, unit variable costs are unaffected by the volume of production. That is, provided that variable costs per unit remain unaltered at the changed level of production activity. Profit per unit in any period can be affected by the actual volume of production in absorption costing. This is not the case in marginal costing. In marginal costing, the identification of variable costs and of contribution enables management to use cost information more easily for decision-making purposes, such as in budget decision-making. It is easy to decide by how much contribution will be affected by changes in sales volume. Profit would be unaffected by changes in production volume. Now let us check if we have understood the various concepts discussed in this lesson clearly. Cost can be measured as the change occurred in the cost of operations due to change in the level of production. Right or wrong? Wrong. Variable cost varies along with the level of production. Right or wrong? Right. Profit volume ratio is nothing but the ratio in between the contribution and sales. Right or wrong? Right. Before we end, let us briefly revise what we have studied till so far. Marginal costing is one of the important tools of management, not only to take decision but also to fix an appropriate price and to assess the level of profitability. Marginal cost is nothing but a change occurred in the total cost due to a small change in the quantity produced. Absorption costing and marginal costing are two different techniques of cost accounting. Absorption costing is widely used for cost control purpose, whereas marginal costing is used for managerial decision-making and control.